Hi, everyone. This is Mike Wilkerson. I am the founder of Stormwall Advisors, the host of Stormwall.com, and the author of Why America Matters. This is the Stormwall Advisors monthly update for March 2024. If you're watching this on YouTube, please don't forget to give it a like, a share, subscribe to my channel here on YouTube. And you can always check out all of my writings and videos at Stormwall.com. This month, on March 2024, I want to talk about the continuing banking crisis that no one seems to be talking about, which I keep reiterating we are still in the middle of. And so I want to talk about the fact that even though the collapse of Silicon Valley Bank and Signature Bank and First Republic and the International Investment Bank Credit Suisse all happened in the first half of last year within a few weeks of each other, and that we've had a pretty quiet time since then, the banking crisis is not over. And I argue that we're likely to see a second leg of it here in the first half of 2024, if not later. So I want to jump into it. As per usual, what I'd like to do is I'll sort of talk over some slides that I prepared that go through this in some detail. Hopefully, you can follow along. If you're watching this without video and just listening on audio, I'll try to communicate as much as we can along the way. So I want to share the screen on this and go through it. Let me make sure I can do this right. So I wrote an article just a few days ago called U.S. Banks Should Beware the Ides of March. And just by way of background, the Ides on the Roman calendar were the middle of the month, and famously in the year 4040 BC was the time famously noted by William Shakespeare about the assassination of Julius Caesar by colleagues in the Senate who had betrayed him. And it's become a bit of a watchword to say, beware the Ides of March, as to be aware of what's going on. And I said this and I wrote it because I believe that it is possible that the crisis in the banking sector could become very visible with something happening as early as this month. And so, bit of a strong statement, given that we're almost halfway through it, but we see some signs that there are continuing issues in the banking sector. I've been on this theme for a while. I wrote an article at the end of the year called "The Banks Are Not Okay," which talked about some of these same issues. And I thought roughly 3 months later to come back and reiterate some of these points. Now, one of the big issues that led to the collapse of Silicon Valley Bank was this unrealized losses on securities in their portfolio. With the rise of interest rates, that those positions had fallen into loss positions, and Silicon Valley Bank was by far one of the most exposed to their securities book, but not alone. If you look across the banking sector, by the end of the third quarter of last year, there were over 624 billion of unrealized losses on securities in U.S. banks. That had been an increase of 22% over the previous quarter. But something interesting happened in the fourth quarter of this year. The total amount in the system of unrealized losses fell by 30%, down to 478 billion. Sounds like things are better, but a lot of those were two-thirds of it, roughly, of the $200 billion decline was due to remarking mortgage-backed securities, which of course was the issue that led to the global financial crisis, or was at the center of the global financial crisis back in the early 2000s. Now, if you look across the entirety of the banking system, and not just unrealized losses on securities, but when you include loans, leases, and everything else, if all of those unrealized losses were marked to market, you're looking at about 1.5 trillion in unrealized losses system-wide. Now, as it turns out, in that scenario, nearly 40% of all banking system assets held by banks would have an adjusted equity ratio below the 6% level that's defined as well capitalized by the regulators. And you see that on this chart here, an analysis prepared by Paul Kupik just last month, describing that nearly a substantial minority of banks would not be adequately capitalized if those losses were identified and realized. This reminds me a lot of what we saw in the early 2000s and 2008 in the global financial crisis, that regulators are refusing to notice the gorilla in the room, the number of banks that are facing capital challenges. So if you go back all the way to 2008, here we are in the midst of the crisis, And the FDIC isn't really noticing it, isn't paying attention. It's only 2 years later when they identify over 800 problem banks that they put on their list of problem banks. It was sort of after the fact, after the proverbial horse is already out of the barn. So in this quarter, fourth quarter of 2023, we saw the FDIC increase the number of problem banks from 44 to 52, so increased by 8. That still represents just over 1.1% of the total population of FDIC banks, and it represents about 66 billion in total assets. But what's going on is that both delinquencies, late payments, and charge-offs by the banks increased in the fourth quarter, largely driven by credit cards and commercial real estate. We had the highest level of non-owner occupied commercial real estate charge-offs since 2012. The issue is getting worse for a lot of these banks severely, especially those in the commercial real estate sector and consumers as a result of exposure to credit card debts. So what it seems to me is happening is very much like what happened in 2008, which is that the regulators are refusing to notice the gorilla in the room, refusing to notice what's actually going on, and the problem is much worse than they would admit. Now, if this is true, the FDIC is actually not really going to be in a position to be able to do much about it. So the Depository Insurance Fund covers only 1.15% of insured deposits. And the banking sector this year was forced to cover a lot of the losses that the FDIC was likely to absorb or expected to absorb from the collapse of Silicon Valley Bank, Signature, First Republic, et cetera. And as a result of the charges that FDIC was placing on the banking system, U.S. Bank's profits fell in aggregate by 44% in the fourth quarter of last year. About 70% of that profit decline was due to over $3.1 billion in fees that went to cover the FDIC's fourth quarter provisioning for losses and for $600 million of operating expenses. Now, if you look within the entire banking sector, 11% of the banks are just completely unprofitable altogether, which is the highest rate that we've seen since the fourth quarter of 2017. And the point to be made here is the FDIC's Deposit Insurance Fund, the fund from which depositors are intended to be made whole in the case of bank failure, it's underfunded. So right now there's about 121.8 billion of assets in the DIF. This represents only 1.15% of the $10.6 trillion of insured deposits system-wide. And by the way, it's below the statutory minimum required by law of 1.35. They've been below 1.35 since 2020. There's a plan to try to replenish this over the next few years. But the point being, whether it's 1.15 or 1.35, essentially you've got 98% of insured deposits that would not be covered by insurance or not able to be covered by insurance in the event of a system-wide crisis. I want to just mention, going back last year, over the course of 2023, we saw over $1 trillion of deposits leave the U.S. banks by the time of April 2023. So in the midst of the Silicon Valley Bank crisis that had started towards the end of the year already, over the course of 22 and then 2023, loss of $1 trillion of deposits. We saw in the fourth quarter some of those losses reverse. We had about a 1.1% increase in deposits in the banking system. That's good. Half of those came, however, from uninsured deposits that would not be covered in the case of loss anyhow. But when you look at the magnitude of the losses, $1 trillion, you've got about 187 billion that's come back. Certainly not in a position where a lot of the banks, especially the smaller and mid-sized banks, are able to retain deposits and grow deposits. And we saw over the same period of time, the federal home loan banks have been borrowing in 2023 a total of $1.1 trillion in new debt, and advanced $584 billion from the federal home loan banks to the banking system in the fourth quarter of 2023. What's this saying? The saying that the banks are not able to raise deposit funds on their own. They're looking to the government to be able to fund their assets, fund their liabilities. And the bank profit model for a lot of these smaller regional and community banks is just completely broken. When the Fed and the federal home loan banks are charging member banks between 5.5% to 6% on advances and loans, this is not a profitable model for a lot of the smaller banks. They are taking losses, and over time, this will deplete the bank capital. But the strapped regional banks really have no alternative, because they aren't able to get deposits in the market in the ordinary way. And we see this when we look at the Bank Term Funding Program. So the BTFP was an emergency program put in place in March of 2023 by the Federal Reserve in order to provide liquidity to the banking sector. And here on this chart, you see at the time in April of 2023 that at its peak, the U.S. banking system had borrowed $79 billion from the BTFP. Well, now a year later, the banks have 164 billion outstanding as of March 2024, double the amount in April 2023. So a clear sign that the banks are struggling to find funding. That program was put in place in March of last year based on unusual and exigent circumstances in the banking sector. In other words, the risk of massive deposit runs. The authorization funding is set to expire now, effectively this week, which means that there will be no new loans. But for those advances, those banks have a year from the time they borrow it to repay that outstanding 164 billion. So they've got a bit of runway, but it's quite expensive because the Fed is charging them 5.4% interest on those borrowings. So it's expensive when compared with deposits, but especially the smaller and regional banks are unable at this point to come up with adequate deposit funding, as we've seen now by the continued reliance on the BTFP and on the home loan banks. And when you look at this interesting analysis by Zero Hedge, shows that when you look at the small banks' cash, excluding the BTFP, that their amount of cash is quite low, just over 4% relative to assets. The big banks in this line here are in a much better position because the big money center banks, the JP Morgans, the Citis, et cetera, have been able to continue to maintain a growth in their deposit funding and find other means of support, including more profitable models. But the banks themselves as a whole appear to be challenged for their liquidity. So we've seen an additional factor here, which is the banks have taken out $2 trillion of cash from the reverse repo market. Again, another borrowing program of the Fed from at the peak in 2023, when going into the year, the banks were flush with liquidity. They parked a lot of that cash at the Fed, and it peaked at nearly $2.5 trillion in early 2023 before Silicon Valley Bank and the collapse. Well, today, the reverse repo program has been largely drained. There's 444 billion left, which means that the banks are struggling for liquidity and turning again to another aspect of the government's programs in order to fund their needs. Now, at the same time, the reserve balances at the Fed have doubled since 2020. So we see something opposite going on here, which is that the too big to fail banks are parking a lot of their excess cash and excess liquidity at the Fed. They're earning 5.4% relatively risk-free on these reserve balance deposits at the Fed. And then the question for them becomes, well, why bother to lend if I can gather deposits at 1%, 2%, and lend them basically to the government, to the Federal Reserve, to the central bank, and earn 5.4%, earn a positive spread, risk-free basis. And this is creating a perverse incentive for these banks, the big banks, not to lend and rather to make profitable margin on that spread. Now, I want to go back to a year ago. So after the Silicon Valley Bank collapse, Treasury Secretary Janet Yellen testified that our banking system is sound. And a few days later, Jamie Dimon, the CEO of JP Morgan Chase, backed this up by saying the same thing, that the American banking system is extraordinarily sound. This part of the crisis is over. This has nothing to do with 2008, 2009 for a lot of different reasons. But coincidentally, JP Morgan holds by themselves over 10% of all US deposits. So one of the largest of the too big to fail banks and arguably the most successful in gathering deposits. And JP Morgan has been the acquirer of a lot of these smaller banks that have struggled. Well, all of that was good and sort of keeping with the party line, but we see the reveal of what was really going on last month in February 2024, when the Fed finally says the quiet part out loud. And during the Federal Open Market meeting, the Fed removed language from their sort of standard policy statement and removed a statement that said the U.S. banking system is sound and resilient, and basically raised significant concerns about whether the banking system was actually in trouble, which is consistent with what I've been saying and what others have been saying for the last few months. So now the Fed finally is quietly saying the same thing and no longer backing up the statement that everything is fine. And I think it's important to remind that in last year, in 2023, we saw 3 of the 4 largest U.S. bank failures ever to occur. Again, we've talked about First Republic, Silicon Valley Bank, Signature. These banks in total represented well over $500 billion in assets. And what we've seen in the last couple of weeks is that the acquirer of Signature Bank assets, New York Community Bank, is now struggling in its own to deal with the acquisitions that it has made. So Signature Bank was merged into, with help of the regulators, into NYCB. NYCB now reported a fourth quarter loss of over $250 million. They cut their dividend by 70% and reshuffled management as a result. Moody's downgraded NYCB to junk, and as of last week, deposits fell by just over 7% in just 1 week. And just again, a few days ago, NYCB announced that they would have to raise capital. They were going to raise $1 billion by the former group led by the former Treasury Secretary Steve Mnuchin. This was 50% dilutive to the existing shareholders that sent their share price down to just over $3 after a $2 and change rights offering. And basically, the shares are now down 70% just from January, just from the end of the year. They're looking to sell their CRE, their commercial real estate loan book. And it's interesting because I think the regulators are doing what they can to prop up NYCB so that they don't have another failure on their hands. And this rescue rights offering by Mnuchin and others goes to the point. So the Federal Reserve itself has been complicit in a lot of what has been happening in the banking sector. So we mentioned before that they're paying 5.4% to the too big to fail banks on their reserve balances. Well, that since they've been doing that, it was one thing when the big banks had deposits at the Federal Reserve when interest rates were essentially zero. But now at 5.5%, this is really starting to bite into the balance sheet of the Federal Reserve itself. And the result of this has been $133 billion in cumulative losses at the Federal Reserve since September of 2022. So in roughly 18 months. Now, ultimately, who will cover these losses? It's the taxpayer. The Federal Reserve will not raise money from its members. They will find a way to shift the burden to the U.S. government, which means shifting the burden to the U.S. taxpayer. And this result will be more inflation. And to the extent that we're seeing the 2024 banking crisis solved, it would be solved by quantitative expansion again, by printing more money, which means that inflation, which continues to bite into the purchasing power of the American citizen, American taxpayer, is going to get worse. Now, I talked about this briefly last month, but I wanted to say again that we've been talking about the banking system itself. There is a bigger trigger risk, and that is the shadow banking system outside of the regulated banks that are non-bank financial institutions, non-bank lenders. Same thing happened in the global financial crisis, where non-bank financial institutions got into trouble when the commercial paper market, their primary mode of funding, dried up almost overnight. Well, today the shadow banking system is even larger at over $1 trillion in assets. As we mentioned, they're relying on the banks and prime money market fund for their financing. And again, if you saw a situation where there was liquidity squeeze or drain, these institutions would be hit the hardest. So we see several points of risk. Just as a note, I want to comment that we saw the CPI index for January come in above expectations at 3.1%. Headline core, when you exclude food and energy, was 3.9%. So it's still 4%, clearly well above the comfort level, and really limits the Fed's ability to reduce interest rates to the market along the way. So expectations for a pivot are certainly delayed, if not altogether out the window. So I want to wrap this up and just leave you with a few takeaways. First of all, the banking crisis is not over. I've been saying that repeatedly over the last several months. There is another leg down here. The easy access liquidity from these government programs is drying up. They're being absorbed. They're being used up in a way that they can. And for the banks, the embedded unrealized losses are much higher than reported. There is a tale of two cities here, absolutely, and that the too big to fail money center banks are actually doing relatively well. So unlike in the global financial crisis where they were the epicenter, the issue in the U.S. banking system is really among the smaller banks, the regional banks, the community banks. And I argue that even now, within the next couple of months, we're at a tipping point with the risk of another set of bank failures. And of course, once the banking system begins to crack, you see this as a broader economic and broader credit market crisis. And I think if I could underscore one point, any banking sector rescue is going to be through quantitative easing, through money printing in one form or another. It'll have a different name, it'll have a different flavor, but the result of this is always going to be much more inflation. So I want to bring attention to this so that we can all be thoughtful about what happens in the event of a banking system crisis, another round of potential bank failures, and to recognize that all of these issues are still out there, and the markets are behaving as if they're not. The markets are behaving as if everything's great and the world is going to continue on. We talked last month about this idea of a soft landing, that we would be able to navigate through this, the Federal Reserve and others navigate through bringing inflation down without crashing the economy, without crashing the banks. And I don't believe that's the case. I believe that a soft landing is a fairy tale, that we do not have a Goldilocks economy. We have an economy that's much worse off than we are led to believe, and that we still have another leg down, another issue to come in the banking sector. So we'll close it off there. I hope this has been helpful. Please don't forget to give it a like, share it on YouTube, subscribe to the channel, and turn on the notifications bell so that you can hear more of the various things that we put out. Check out stormwalladvisors.com to learn more about the advisory work that we do. And you can always pick up all of my writings, all of my videos at stormwall.com. And I'm on Twitter at MW_Stormwall. Thanks, everyone. We look forward to continuing this discussion and look forward to speaking with you again next time around.